Some alarming year-over-year stats and trends, but I'm sure that comes at no shock to you all. But finally, we're starting to see some fight from the real estate and mortgage industry. Data heavy today, let's dig in. Before we do, we've had some really good conversations lately. You need to queue them all up and check them out if you missed them. First, Moneyball Mortgage 2.0 with our good friend Dave Savage. Second, we were also recently on 24/7 Mindset with Wally. We had a really good, deep conversation with him. Third, we were just recently on Market Shares with Tony Balaja, and that just dropped. Tony's a good friend of mine and a student of the game. We do a deep dive on this one, and just recently, last week, the Mortgage Nerd and the Bird and myself, Denise Donahue, Deborah Bird, and myself go deep into this market in depth for about an hour. Check them all out if you missed them. The links will be in the comment section. Back to the show though. Let's take a quick look at those alarming trends, starting with the most obvious: mortgage rates up year over year considerably. And guys, we've reported this a few times this year. They're at 20-year highs, right? As a result, people applying for financing to buy a home is down, as one can imagine. Down almost 20% year over year. Add to that the fact that refinances are all but evaporated this year, and you'll understand a loan officer's pain right now. Another interesting leading indicator is Google Home searches, also down 12% year over year. Super underrated stat here. After all, it all starts with a Google search that leads to a conversation with a realtor or lender about their next steps. So when searches are down, so are conversations, applications, and closings. Believe it or not, medium sale prices are hanging in there though, actually up 2.7 year over year. So are asking prices up 5.2%, which is interesting because you would think these would have to come down with fewer buyers coming to the table. Mortgage payments are up considerably. I don't love this slide, guys. I mean, look at the difference between 2020 and 2023, the gray and the orange lines here. Oof. Pending sales, new listings, active listings, all down as you can imagine. Pending sales down almost 12%, active listings down 14%. Lastly, the Redfin homebuyer demand, which is defined as a measure of requests for tours and other home buying services from a Redfin agent, is down 5% at the lowest level since 2020. Again, no big shockers there, but worth looking at. What is interesting though is finally just this week, our advocacy groups and lobbyists are starting to punch and fight back, which is good because it started to feel like Rocky 1 when Apollo was just whooping Rocky's ass with no punches back or responses. Finally, we punch back. Check this out. NAR, the MBA, the National Home Builder Association, the Community of Home Lenders of America, and the Independent Community Bankers of America all punched back, telling Jerome Powell, Biden, and the Fed to knock it off. Now, sure, this might be like Karen writing a sternly worded letter to the HOA about Sparky the dog barking too loud or too many cars being parked on the street. But hey guys, it's something. They told the Fed, hey dummies, stop it. I kid, they said it in a nicer way, but essentially they said, ongoing market uncertainty about the Fed's rate path has exacerbated housing affordability and created additional disruptions for a real estate market that is already straining to adjust to a dramatic pullback in both mortgage origination and home sale volume. They also urged the Fed to not contemplate further rate hikes and not sell off any of its mortgage-backed security holdings until and unless the housing finance market has stabilized and mortgage to treasury spreads have normalized. Now, these were actually two different efforts, guys. The CHLA, NAR, and ICBA came from a different point of view, but with the same objective, calling on the Biden administration to reduce the historically large spread between the 30-year mortgage rates and the 10-year treasuries. The trade group noted that the spread sits over at 300 basis points compared to historic norms that are about 150 basis points. Action is critical to address homeownership affordability and lending challenges and reduce impediments for servicers to loss mitigation efforts to keep defaulted borrowers in their home. To that end, the CHLA, NAR, and ICBA urged the Federal Reserve to shift its policy to maintain its stock of mortgage-backed securities and suspend runoff until liquidity and the spread of the 30-year fixed rate mortgages and 10-year treasury stabilizes. Now, will the president and the Fed listen? I don't know. I'm just happy that these organizations and trade groups are finally starting to fight back for us. This is part of their job and we appreciate them for it. Collectively, we have influence and leverage, a lot of it. Heck, NAR alone is the largest trade association in the US. Add in the rest of the groups we just mentioned today and we have a very loud collective voice. We just need to use it more often. Appreciate NAR, the MBA, and the rest of them for fighting back for us. Will we be heard? I don't know. That will remain to be seen. But share this with somebody that needs to hear that and let's get the word out. Rocky, that's us, is getting off the mat and starting to punch back. See you guys next week.